Hi guys, so finally the video is here. It's almost 4 o'clock right now, and after a lot of deliberation and everything, we finally solved this question, and the solution is here. Now, in the spirit of TEDx Micah, I'll try and finish this entire uh, recording in less than 18 minutes. So, firstly, I'll share the doc once. So, this entire thing from the title you must have read, it's on PPP. Now, what is PPP? PPP is a public-private partnership. Now, public-private partnership is where government and a private entity come in collaboration with each other, and they collaborate to do some kind of a infrastructural facility. So, in this case, we are building a highway, and we'll put a toll booth on that highway, and we'll get people to pay toll tax on every time they pass through. Now, through this the entire thing, we are asked what will be the return on investment for the debt, what will be the return sorry what will be the return on investment for the government, what will be the return on investment for the company, and what will be for if you want to achieve break even point, what should be the minimum toll tax that they should charge. Okay, so that's the entire thing. Another concept here is called an SPV, which is not relevant to the question, but they may ask you, sir, may ask you this question: what is SPV? SPV is basically a special purpose vehicle. It's a dummy company, let's say, where multiple companies put their funds into, so they invest equity in that SPV. That SPV takes a loan from the lenders and invests in a project. Now that project, you for that loan you pay the interest and principal to the lenders, and from that project you get dividend, which you pay back to the SPV, and the SPV pays it back to the company. Right. Now there are three kinds of risks that are there: counterparty risk, project risk, and third party risks. I'll not go detail here. In case a question comes, we'll solve it then and there. um, For the rest of the thing, I'll just go back to my Excel where I've basically written down the facts of the case. So these are the facts of the case. Initially, we are investing 5,30,000. So visualize this. We are making a highway. We are making a highway, for which we'll need 5,30,000. We need 60,000 as working capital. So total investment comes to 5,90,000. Government is giving us land worth 8 lakh rupees, on which it will charge 9.75% lease. So this is payable every year at 78,000. Now whatever in machinery and everything we are putting, or what all the investment that you're making, depreciation is 1 lakh per year, and net salvage value is 30,000. So at the end of the 5 years, we'll get 30,000 back. We are estimating that on that highway there will be 25,000 cars that are going every year, and each of them will pay an average toll of 70. From whatever toll we get, 65% of that is variable cost, and 15% of that we have to share with the um, government. Okay, so the government is getting two things: is giving us the land for a lease, and also getting a revenue share. Now the government can do multiple things over here. They can say that, okay, instead of putting, you don't give me revenue share, you give me a lease. Instead of 9%, you give me 12%. So that can be a different question, that if sir asks that, okay, what will happen if government asks for 15% as lease rental and does not want revenue, or if government wants only 5% lease rental and revenue share is 25%, what is the ideal situation? So that's not the question that we are dealing with right now. Right now what we have been told is 25,000 cars are traveling every year on that road, each giving me 70 rupees every time it travels. Okay, 65% of whatever sales or whatever money I acquire is my variable cost, and 15% of whatever money I acquire, I have to give to the government as a revenue share. Fixed cost is 72,000. So fixed cost 72,000 is given. Okay, now for now, ignore these figures. I'll explain what they are, but it's not relevant for the sum. Now fixed cost is 72,000, and the required rate of return. So required rate of return is the rate with which we discount the whatever cash flows we'll get, we'll discount the entire thing. ROE is return on equity, which is 19.5%. RD, it should be RD, is return on debt, which is 9%. FCFF. So basically, in what we are trying to do is basically, you put, let's say this is the timeline. Okay, I don't have anything right now to show a timeline, but let's say this is the timeline. On the 0th year, you are putting money. Okay, every year you're getting money back from the project. On the last year, you're getting money back, as well as whatever in you invested, that money you will get some salvage value from that. So 30,000. So you invested whatever money, out of that 30,000 you're getting back. You're getting back the working capital that you invested. So initially you are putting some fund, you're getting a return every year, and in the last year you're getting not only the return but also the return from the working capital as well as salvage value. Now you take the present value of all these things and compare it with the initial investment and see whether it's profitable or not. If the present value of all the inflows is less than the outflow, in that case it's a net positive. So it's a net present value is greater than zero, which is good. If the inflows is less than the initial investment, if the present value of the inflows is less than the initial investment, in that case the project is not viable. Got it? So this is the entire question. Now FCFF, so basically there were some ranges given in the question. So sir said that 25,000 cars I'm estimating, but it could be plus and minus 4%. So similarly for average toll and variable cost and everything, there was a range given. So with that you do a base, lower and upper. So what this is basically it gives you three scenarios. So worst case scenario, best case scenario, and a base case scenario. So we are considering for the question, and even if question comes in the exam, we have to do the base case scenario. Okay. So for the base case scenario, FC comes to sorry. Now what we are for the forget these two. For the base case scenario, what we are estimating, there are 25,000 vehicles, each of them giving me 70 rupees toll. So 70 into 25,000 comes to 17,50,000. Okay. Variable cost given is 65% of revenue. So whatever money I'm getting as revenue, after out of that 65% is variable cost. Remaining I'm sharing 15% with the government. So 15% I'm sharing with the government. Whatever is left, so this minus this minus this comes to contribution, which comes to this minus fixed cost. Fixed cost was given 72,000 minus lease payment 78,000. You remember in the question it was given lease payment here 78,000 minus depreciation. So this is basically, let's write depreciation. This was also given in the question, 1 lakh as the depreciation. Now if you remove all these, this minus this minus this minus this comes to EBIT, which comes to 1 lakh. So this minus this minus this minus this comes to 1 lakh. 1 lakh minus interest. So currently I'm assuming zero debt, we are investing everything, so it comes to interest at zero. Taxable income is 1 lakh. Tax rate is given as 34%. So 1 lakh mein tax rate 34%. So 34,000 is the tax rate. Net income, this minus this equal to net income. I add back the depreciation. Why I add back the depreciation? Because we want to because see, we are we are trying to figure out the cash flows. Depreciation, though it is an expenditure, it is not a cash expenditure, it's a non-cash expenditure. So we add everything, all of those things back. So from the net income you add back the depreciation, which comes to operating cash flow unlevered. Okay, unlevered means without the interest. Levered means where you use leverage, which is called interest. Okay, so unlevered means no debt. Now, out of the 166,000, if there was any capital expenditure, we would have reduced those. There's no capital expenditure or investment in working capital in this year. So my free cash flow comes to 166,000. Now, this is the amount of cash flow that I'll receive every year from year 1 to year 5. Now, let's calculate the NPV based on this. So for the NPV, year 0, I invest 5,90,000. Remember 5,90,000 in the facts it was given. 5,30,000 plus 60,000, which comes to 5,90,000. 166 is the free cash flow, which I'll receive every year. So free cash flow I'll receive every year is this. For the 5th year, not only am I getting the free cash flow, but also I'm getting 60,000 back, which is my working capital, and 30,000 back, which is my salvage value. So where was this? So in the working capital, it was given 60,000 here, and my salvage value was given over here. So I initially invested 60,000, which I was using to run my business. So that's working capital. So that I'll get back when I stop the business. So I'll get that back, and also I'll sell off the machinery and everything, and that is called net salvage value. Okay. So net salvage value is basically when you sell off the machine. So for example, you have a microwave that you want to sell. You bought that microwave for, let's say, 10,000, and you want to sell that microwave for 4,000. So your 4,000 is your net salvage value. Okay, I know it's a relevant okay. Anyways, jokes apart, uh, 590 is the entire investment that I made initially. 166,000 is my cash inflows every year, which I calculated in FCFF sheet. Last year what I'm getting is 166,000 as well as 60,000 and 30,000. What I can alternatively also do is I can write 90,000 here, and 160. I'll just continue this 166,000 here. Even in that case, the entire thing is fine. So equal to sum. Maybe this approach will help you understand better. So for 5 years, 166,000 initial investment, and last I got a salvage value of 90,000. If I add back the present value, so present discounting, I discounted it on base of the RRR, so that comes to 15%. Present value is basically this multiplied by this, comes to 144. Add everything up, you'll get the present value of the project. From that you decrease the investment. So you invested 5,90,000. This gives you the net present value of 11,204, which is positive, which means that the project is good to go. Now, if I want to calculate the IRR, I would do equal to IRR, and basically here you'll get a problem because you split that entire thing. So Control Z, 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 Z. Okay. So basically, because I was splitting this thing, it was considering this as 6. So that's why it was coming as 12 point something. But the IRR is, so basically you go to the IRR cell, write equal to IRR. Make sure it's 0 figure is here, and then whatever months. So 15.75. So initially my return on equity, sorry, my required rate of return was 15%, but I'm getting more than that. So 11,204. So that's why my RRR is greater than my RRR. Okay. I hope this part is clear. It's just normal term to CF. Now, what I'm thinking is, instead of doing the entire project through equity and investing my own funds, I want to borrow some money and put some leverage. So it's called debt. So I want to put some debt, and I have thought that I'll invest 1/3 in debt. Now, out of the total investment of so out of the total present value of the project, I invest 1/3 in debt. Why present value of the project and not the investment? Don't ask me, I don't remember. Like right now I can't explain everything because that will take too much time. Okay, so what I basically did, I did this 601,204 divided by 3. That gives me debt. Now total investment required was 5,90,000. So is in 1/3 of the entire investment is coming from debt. Don't do 1/3 of this. You have to do 1/3 of this yellow. Okay, I'll just put a cell. Okay, okay. Do 1/3 of this. 1/3 of 601,204. That comes to 200. 590 minus 204 comes to this. This is my equity investment. Interest, okay, on this debt of 201. So on this debt of 200 401, I'll pay interest at 9%. So 9% was given in the question, and tax was 34%. So 9% comes on this 9%, it comes to 18,000 minus tax 6,000. So tax is basically equal to this into 34%, comes to 6132. Post tax interest is basically equal to this minus this. Sorry, equal to this minus this. Unlevered cash flow basically is the cash flow that was being generated before I took the debt. So before I took the debt, my unlevered cash flow from this sheet was coming to 166,000. So I put that amount. Then I reduce the interest. So my interest payment, post tax interest payment, because of I'll get tax shield um, of 11,000. So that's why from that you reduce the interest portion, which comes to the levered. So basically, due to the leverage, what is my cash flow? My cash flow will reduce because I have to pay interest. So my levered cash flow is 154,096, and I am investing 5 lakh. Instead of 5,90,000, I'll only be investing 3,89,599. So this is what I'll just color this. So this is the equity investment that I'm getting, and this is the amount of return that I will generate for my shareholders who is putting the equity. So now I have to do the NPV calculation again for a levered form. But instead of the 5,90,000, I'll take the investment as 3,89,599, and I'll take the cash flow as, instead of 166,000, I'll take 154,000. Okay, so I've taken that amount, 3,98,599, as the initial investment, and my every year my levered cash flow is given over here. Rest of the thing is all same. Okay, now this is 15%. Focus on the last year's on the last year of the question. So what I'm thinking over here is, let me simplify this a little bit. So I'm getting 1,54,096.17. That is from there. Out of this, I'll one second. Okay, let me explain it like this. Total, I am getting 1,66,000 as unlevered CF. From this, I reduce 11,904. This gives me 1,54,096 as my levered cash flow. Okay, so levered cash flow, interest payment. Okay, so this is my levered cash flow. In addition to the levered cash flow, what will happen is I have to repay the loan. So minus this loan. So this is levered repayment of loan, and also repayment and payment of interest already I've taken. Okay, so I'm repaying the loan and salvage value of 60,000 plus 30,000. So this comes to 90,000. Okay, so equal to this minus repayment plus this. Sorry, I'll just add everything. So because it's already negative figure, so sum of TTT. Now this comes to 43,695. This is my unlevered minus interest payment, which comes to levered. Levered minus repayment of loan plus salvage value comes to my cash flow for the year 5. Now for year 5, this is the cash flow. For the remaining years, my cash flow is 154,096. Okay. Let me delete these two arrows because you'll get confused. Okay. Now what is happening is I'm using this to calculate the PV, new PV, based only on the levered cash flows. So basically what I'm trying to find out is, if I took a debt, what amount of return would my shareholders expect? So this is my present value of the cash flows, which comes to 4,61,000, 4,61,665. I reduce the initial equity investment only, not the debt investment. Only the equity investment, which comes to a present value of this. Now, if I do a IRR, so equal to IRR of this, that comes to 23.4943, which is obviously higher than 15.78. So always, if you're paying, if you're taking loan, your shareholders will also increase or want more. Okay, so that's fine. FCFF. Now what I'll do is, based on this, so this is my IRR calculation done. Okay, now the second part of the question that they wanted to know was, I think I'm not, this is not a TED talk because it's over 18 minutes obviously by now. So the last part is left. So basically what they also wanted was, if I only want to break even, what would be my, uh, what amount of toll would I charge? So basically what I've done is I've taken the unlevered NPV, so this entire calculation, and I've broken it down into three parts. So first part is the initial investment, second part is the cash flow from your unlevered cash flows, and the fifth part is your salvage value. Obviously the IRR will not match because the IRR, uh, this is broken into two parts for the same year, so that's why IRR is not matching. Now what I want is, for year 0 I've put my present value over here. For year 5 I know my salvage value. Now what amount of money should I get each year so that it actually receives break even point? Now if you try to calculate this, for the first year, for year 0, basically the entire thing will be 590. For year 5 you use this discounting rate and you'll come to a value of 44,745. Now if you add these two up, these highlighted two things, that comes to an net investment, net of salvage value, as 5,45,254. So this is my net investment. When you divide that with the present value annuity factor of the 5 years, that comes to 1,62,665. Wait. I know everyone is getting confused at this point. Ki kya chal raha hai? Kahan se aa gaya? Listen to me. Okay, this is the last part. Don't worry. I'll explain it again. 5,90,000 is my initial investment, and 90,000 is what I'll get back. 60,000 as my working capital recovery, and salvage value of 30,000. So 90,000 is what I'll get back. Now I'll take the present value of both of this and I'll find out the net investment that I made. So what I'm trying to figure it out is, what is that X amount of money that I want to earn every year, so that at the end of each year I break even. Basically it's the minimum amount of money that I need for this project to be a success. So I'm assuming X to be, for this thing value to be X, and I've taken for each year, I've taken the present value, added them up, that comes to 3.352. Now you multiply that, so it comes to 3.352x is equal to 5,45,254. So basically what this says is that every year you need a minimum balance of 1,60,000, minimum unlevered cash flow of 1,62,654.78. Got it? Now the final part is, if my entire unlevered cash flow, so you remember this entire FCFF calculation. So how we went from calculating the revenue to calculating the free cash flow. Now we'll do the opposite. We know what the free cash flow is, and now we'll track it back and find what will be the amount of, this is 25,000. So I need to find the amount of toll that we can charge, minimum amount of toll that we can charge. What we'll do, free cash flow 1,62,000. There's no investment or capital expenditure, so this is fine. This will also be the same. Add back your interest. This comes to a this is your operating cash flows. Now add your operating cash flows, you add interest and depreciation charges, which comes to a net income of 62,000. So from your net income, depreciation had been added back. So now when I'm calculating net income, I'll reduce this. So this is basically 1,62,000 minus 1 lakh, which comes to 62,657. Now if 62,657 is the net income, what should be my taxable income. So basically what this is happening is, this is 100, this is 34, and this is equal to 100 minus 34. So what we can do is, you can for here you can do equal to 66,000 is whatever 62,000, this divided by 66%. This gives you the entire taxable income, and the tax rate is equal to this multiplied by 34%. Okay, so that's how I calculated the taxable income and taxes. Interest, obviously we are considering again that there's no debt here. Question may ask you for an unlevered thing, but I don't expect that. So there's no interest payment that we are making. So the EBIT would be 94,000. So basically it will be the same thing. Non-cash and this thing, these are the fixed payments. So fixed costs, lease payments, non-cash, so depreciation, these has been reduced from the contribution. So when I'm trying to find out the contribution again, what I'll do is 94,936 plus 1 lakh plus 72,000 plus 78,000 comes to 344,936. Now 334,936 is equal to 20%. So initially, you remember, again, let's do this. This is 100, this is 65, this is 15, and this comes to 20. If you add these up, you come to 100. So out of 100, reduce 80%, you get the contribution. This is given in the question. Now, if 3,44,936 is 20%, then what is 100%? So that's how I calculated the revenue. You use 75%, 65% as variable cost and 15% as revenue share. So if the question asks you what's the revised revenue share, this would be the revenue share. This is the entire revenue. Now this is the amount of money that I need, and I already know the number of vehicles that will be plying on that road. So you divide that revenue divided by the number of vehicles, and you'll get 68.99. Now if Archit was there, he'll be like, just thoda sa ho gaya. ठीक है, let me just round it up. So I hope Archit is happy. I hope he is watching the video. But anyways, so this is the entire tool that I would be charging. Now the question may give you different facts. So instead of this fact of 15% share, it can say you only give the government 5% revenue share. In that case, what is the break-even toll? Now, because my entire sheet is linked, when I put 5% over here, you can see the toll has changed to 46. If I change this revenue share to 25%, in that case, you can see the toll will change to 138. So that these are things that will automatically happen if you change the figures. So this was the question. Now I'll just take you back for a moment into the slide. Okay, so I've explained everything. Again, I'll just show you where that 69 was. So this was my toll, and at 15% the toll is 69. At 5% the toll is 46. At 25% the toll was 138. So somewhere in between. So sir can ask you what would be the toll at different price points, at different revenue share percentages. So that would be an answer. Now, similarly, a question can be asked of that, okay, instead of 9.75%, if the lease rate was different, it was 7.5% or 15%, what would be the impact on the break-even point? So as long as your sheet is linked, that should be fine. Mine is not completely linked. So that's a problem, but again, if a question might be different, so fine. ROE, weighted average capital, this is not relevant, leave it. Okay, so this is a matrix that sir was talking about regarding the revenue share and land lease. So when the government is trying to make a decision, they can say that, okay, I want at least 60 and above as my toll, and maximum the people can pay is 75. So this is the price band which you can keep. You can either put 15% revenue share and 9.5% land lease rate, or you can reduce the land lease rate and increase, you'll reduce the amount of money, or increase the revenue share, or whatever permutation combination you want, you can do that. These entire portion, these are not there. I think sir has not covered these portion, so don't read these things, because this is the only video that I will be making. So I'll just again try and give you a summary of what you should do. Ideally you should have done it first, but okay. So this is my PPP slide. So there are 3 slides in the entire GCR. These practice assignment questions and answers are uploaded here. Shagun has also uploaded the solutions for all of these. So you can watch those videos, definitely watch those videos. Raising capital is another PPT that was given here. So this is entirely theory part. Let me just check if there is something. Venture capital. These are all theories, and I don't know why he keeps giving these rules 1415 or something like. These are US rules, and in India it's called self prospectus section 31. So I don't know why he gives US rules, but anyways, these are all I think proper theory parts. So in case something comes, you can always refer to these. Um, it's an open book exam, so you can refer to whatever you want. Right offering, another question was solved, which is on the channel regarding the rights offer. You can refer to that video. Yeah, so that's the raising capital wala thing. Hampton machines and Gilbert is not relevant, so don't even read those things. PPP, I've covered this in this video. Working capital, so working capital, you can refer to the older video that I have made. There's no addition thing. If you remember the how to calculate the 2 by 10 net 40 whatever those things, so you can refer to that. Only one addition is in cash management. There is a Miller or model which also Shagun has covered, so don't worry, that is covered. Managing short-term finances, so this is also covered in the video. I think the first video that I calculate. So this is the working capital thing. um, this is also covered, so don't worry, it's also there in the channel. Okay, so let me see. So I think this part was where I left the last uh, video, and after that this Miller all model and the optimum cash balance model is there, nothing else. Okay, so the only Miller all model is what you need to study. But that's it for Manikant Mishra's slides. Other than that, I have also made a doc, so I shared the doc link. Okay. So basically, the 25% is Taral sir's part, 75% is Professor Mishra's part. Taral sir's part is easy, so try and finish that first part. Valuation of securities, bond valuation, equity valuation, working capital management. This is already covered. After that, only one part is there, which there's no need to make a video. So I'm removing that part. Financial forecast and planning, I've already done it in the midterm, so you can refer to those midterm questions. Cash budgeting was done in the Gilbert in the Hampton case. Cash budgeting, yeah, I think Hampton case was the cash budgeting thing. Project financing I've covered, and this is entirely theory. So that's it for the videos. Now, Shagun will be uploading this second question. Remaining all are done. I'll upload this video as well, and you can watch that. So hopefully you've understood everything. I know it's a little complicated, and apologies for uploading it very late. Um, Hopefully you have time and you can solve this video. And yeah, thank you for watching. This might be the last CF video for this year. And best of luck. And yeah, stay live.